September 22nd, 2015, investment meeting of the New York City Employees Retirement. Diane, would you call the roll?
Chair,
Here.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan. Borough President Brooklyn.
Present.
Borough President Queens. Borough President Staten Island.
Present.
Borough President Bronx.
Present.
Council Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Present.
We have a quorum.
Thank you. It's your turn. Mr.
Okay, thank you, Mr. Chairman. We're going to turn to the total fund overview. This is the new quarterly package that's been promised to you. We've changed it up a little bit. If you turn to page 16, I'll talk about it. There are a lot of new things.
We don't have it.
I'm going to hand out extra copies.
Oh, I'm sorry.
Extra copy, we never got it.
It was emailed, but
Yeah.
we had some.
Other copies for everybody? There you go.
Yes.
As you know, we've been working on this new quarterly report for a while. We've shortened it. People have requested that we make it a lot shorter. We've tried to take out duplicate coverage of issues and so forth. If we took anything out that you value and what would like to see in the next quarterly report, please let us know and we'll put it back in. But we have, as you can see, turned it into a thin document. So what, other than it being smaller, what improvements are included in this quarter's packet versus what we had before? As promised, we're incorporating additional fee transparency into our quarterly reports today. Our reporting format has been altered to shorten the packet and to clearly focus on net performance versus policy benchmark. We welcome your input on the contents, as I mentioned. This report gives you our best estimate currently of investment performance net of fees. The accuracy of our fee estimates will improve as recent transparency initiatives are realized and put into practice in the custodian's performance reporting process. The documents in this public packet will be placed on the controller's public website at the conclusion of our quarterly meeting cycle. Information in this packet will be included in its entirety and will also be supplemented by a detailed performance listing for each manager that compares net performance to policy benchmark for periods beginning 1/1/14. This is the first time that we will have displayed the net of fees performance in its entirety. So what's still to come? For our public market mandates, we'll add an adjustment for fee reductions related to the attainment of contract maximums. I can talk about that in the executive session if you like. And for private market mandates, as managers begin to comply with formal requests from BAM for more extensive fee and incentive payment disclosure in the capital call and distribution notices, our fee drag estimates will capture a larger share of private market fees and incentive payments. This quest for fee transparency was the motivation for the controller's decision to become a signatory to the recent letter from a consortium of state and municipal finance officials to SEC Chair Mary Jo White. We also plan to convert the private market fee estimates to an accrual basis so that the fees charged are more properly apportioned to the time period over which they were earned by managers. Okay. So much for a statement on incentive fees. If you turn to page 16, you can see the results of it. You'll notice on the very left-hand side we have line numbers. As the asset class heads go through this report, they'll be referring to these line numbers to help you get your bearings. We'll turn to line 6 first, and you can see that the total NYCERS portfolio was a little over $54 billion at the end of the quarter. At 2 columns over, the fiscal year to date, or the entire fiscal year 2015 ended June 30th. 3.40 is the portfolio gross of the fees that we're going to include here, and net of everything else, so mostly private market fees. That 3.4 was the number that we had been reporting in the past. We have identified 29 basis points of fees, 13 basis points in the public market on an accrual basis, and 16 basis points in the private markets on a cash basis. I'll warn you that the cash basis is lumpy because you'll get in charges for multiple time periods, and it'll waver quite a bit. And this is why we are attempting to change that to an accrual basis also, so that we can align the expenses with the period that they were incurred. The portfolio net of these fees is 3.11%. Versus the benchmark of 395, so an 84 basis point behind the benchmark performance over this period. You'll notice that the 84 is in red, and then if you look one column to the left, the 3-month results, just the fourth quarter, is in green, and the red and green denote the net performance, green being positive, red being negative. We'll use that same rubric throughout the asset classes. If you look over to page 2013 and before, you'll notice it's not red or green, it's black. And parentheses for negative and no parentheses for positive. The black on the net line shows you gross of fees. So for instance, in 2013, 1573 versus 1533, but that's the old way of looking at it, gross of public fees, net of private. And we simply don't have the details on the history. We're going to try to drive it back as best as we can. As you remember, we changed custodians in 2013, and that really complicates the ability to go back with history. But going forward, we will do everything on a net basis. Any questions about the presentation of the fees and everything before I move on? It's important that we get it. Yes?
Yeah, I think it's very well done, and perhaps we could ask State Street to enlarge the numbers, because they're very tiny.
I thought it would be good to keep them small until there was less red on the page. We'll absolutely do that. And what happened was, as you can imagine, we're back and forth with State Street, and somehow the margins got bigger and bigger. So we will endeavor to make the print bigger. Okay. Okay. Let's move on then to page 9. It's kind of our traditional look at how we're doing in the quarter, and this is net of fees. The excess return was 16 basis points, as you could see before. 11 to the allocation effect, 5 to the selection effect. If you want to see the details on that, turning to page 12, you can see the asset classes that the allocation effect came from. Most of the positive effect was being short structured bonds, the long-term bonds during the quarter, and that resulted in 9 of the 11 basis points positive. The selection effect down on the bottom, hedge funds were on the negative side. Neil will talk about that. Private equity was on the positive side. And this gives you a sense of, when we talk about being overweight and underweight, the various asset classes. They'll show up on the top panel. How we're doing versus benchmark will show up on the bottom here. With that, we'll go to the asset class heads. They're going to do a quick run through because we have a long agenda and a holiday that's coming up at the end of the day for some, and we're going to endeavor to be done by 4:30 if we possibly can. So, John, why don't you?
I have a dream.
I'd ask everybody to,
What'd you say?
I'd ask everybody to please turn to page 20.
Oh, it's report.
The first section on the top of page 20, line 199, shows the performance of the U.S. equity composite. The composite had net returns of a negative 7 basis points for the quarter and a positive 6.35% for the fiscal year. This trailed the benchmark by 21 basis points for the quarter and 94 basis points for the fiscal year. Detractors to the fiscal year performance include the small cap active managers and the manager of managers. And if anybody has any questions about specific managers, I'd ask that you hold those for the executive session. And then moving on to page 21, the second composite on the page, beginning on line 279, shows that the total developed markets composite was ahead of the EFA index for both the quarter and the fiscal year, while it was behind the EFA IMI index for the quarter, but ahead of it for the fiscal year. And that the EFA IMI is a broader index that adds small cap companies to the EFA index. NYCERS added some small cap developed markets managers in May of 2013, and subsequently added a small cap passive allocation in 2014. So for the more recent trailing periods, the EFA IMI is the better overall benchmark, while more distant years are best judged against the EFA index. Next shown, beginning on line 291, is the total developed active markets composite. And this active composite was also ahead of the EFA index for both the quarter and fiscal year, while it was behind the IMI for the quarter, but ahead of it for the fiscal year. And next shown, beginning on line 303, is the performance of the passive index composite. This composite was ahead of both the EFA and the EFA IMI indexes for both the quarter and the fiscal year. Turning to page 22, in the middle of the page, line 375, we see the total emerging markets composite, which trailed the custom benchmark by 28 basis points for the quarter and 58 basis points for the fiscal year. This was driven primarily by the performance of the active managers, which, as shown in the next composite, trailed the benchmark by 38 basis points for the quarter and 30 basis points for the fiscal year. And then wrapping up at the bottom of the page, we see the passive emerging markets allocation, and that trailed the custom benchmark for both the quarter and the fiscal year by 1 basis point and 10 basis points respectively. Are there any questions on the public equity portion of the report? If not, I'll hand it off to Neil, who will cover hedge funds.
Yeah, good morning. Hedge funds is just one item instead of John's long list. That one item is on page 17, and this quarter it's not a good item. A little disappointing. It's the first quarter since we've been in balance that we have lost a little bit of money. From time to time, we do expect this, though, mainly because our portfolio is very, very concentrated. Just 15 hedge fund investments, whereas the index is very, very diversified. A couple of hundred different funds in the index itself. So, if there are any questions on hedge funds, I'll take them. If not, I'll pass it over to private equity.
I just have one question about the report. The hedge funds is on, as you said, page 17,
Yes.
51. It's also on page 23, number 405.
Yeah, we were hoping you wouldn't notice that, Mr. Chairman. There's some duplication. We weren't able to eradicate it with State Street. They show the high level, and then they show the more detailed level again, including some duplication.
Okay.
And next quarter, you won't see that way. So we try to get it out of there, and then we weren't able to do it. We just gave up. But there's no additional stuff. It's just a duplication.
Okay. Sorry, fixed income.
You all know Robert Fang, who's our acting head of fixed income.
Morning.
Morning.
So I'd like to start off first with page 24, line 437.
So what page?
24.
24.
At the top of the page, line 437, I'll start talking about the fixed income to structured fixed income program, or the core fixed income program, which is about half the entire fixed income allocation. The excess returns were slightly down for the fiscal year, but for the quarter we outperformed. The quarter we outperformed mainly due to our overweight in mortgages and our underweight to treasuries. Next, we'll go to line 467, which is TIPS. TIPS is close to 3.25% of the overall NYCERS fund and 9.5% of the fixed income portion of the fund. With 3/4 of our assets in the passive index, we're pretty much flat to the index. Next, we'll go to line 477 and look at our high yield performance. Our high yield weighting is about 3.8% of the overall fund and 11% of the fixed income portion. Our high yield underperformance is due mainly to energies, metals, and mining. Metals and mining companies continue to experience declining prices due to a slowdown in global demand and weak energy prices. Next, we'll go to page 25, line 487. We'll take a look at our bank loan sector. The bank loan sector is about 1.9% of the fund and about 5.5% of the overall fixed income allocation. Our managers have consistently outperformed the index for the quarter and the fiscal year. A big benefit was the credit selection in the single B space, which overall did better for the second quarter. And lastly, we'll go to convertibles on line 497. Convertibles are 3% of the overall fixed income allocation and about 1% of the overall plan. Convertible return is due to problems one manager had with their index. The index does not cap their names, and manager doesn't feel prudent to go ahead and take the weightings up to the max. And they tend to underperform as equity has a positive quarter. And if you have any questions about fixed income, or we can take manager specific in the executive session. Great.
Thanks, Robert.
I'll turn it to Wesley Implicit for.
And as you know, Wesley is the acting head of our opportunistic fixed income group.
Good morning.
Good morning.
So I'll be on page 19, please. At the top of the list, line 169. So your optimistic fixed income portfolio is 1.3 billion, representing 2.45% of your AUM. For the 3-month period ending June 30th, there was positive performance of 49 basis points, which beats the total plan return of 0.22, but underperforms the 10% benchmark by 192 basis points. This is mostly due, and you can see it actually through the fiscal year-to-date performance. This is mostly due to exposure to the energy sector, which was hit really hard starting almost a year ago. Most of the names are still unrealized losses, and after talking to the managers, they do feel confident, high conviction in those positions. So it's a matter of time before these things play out. We can talk about individual managers in the executive session, but if you have any questions then.
Yeah. Thanks, Wesley.
And now we're going over to
Brian Cook, ETI.
All right, so still on page 19, we're item 179, your targeted investments. As you can see, we were actually down 159 basis points over the past quarter, and this has led to us underperforming by 76 basis points over the last year. This was primarily due to the PPAR program and the evaluation of our loans. So while nothing actually changed in the coupon rate, their value on the open market, which we adjust for, did go down. To give you a sense of how that changed, if you look at your July book, we're up 2.41 for the last 3 months and 2.71 over the calendar year. So it's all the interest rate risks that I've been talking about that we're going to see as people value our loans as being worth a lot on the open market, and then the market fluctuates. So we've already made up the paper losses. So I'm going to go through, starting on page 8 and 9, each of the programs quickly. I'll note that I'm going to reference what our individual programs have done in terms of their performance, but if you'd like me to walk you through those numbers, we'll have to wait till the session. So on page 8 and 9, we start with the giant graph that the big book, which we have actually tried to make slightly bigger in response to your comments. It is not necessarily the easiest thing. We are still working on it. We may have to break it to 2 graphs. The PPAR portfolio underperformed its benchmark by 4% in the second quarter and 3.26% over the last 12 months. Again, to give you context, in July, because this was June, in July we were up at 5.45 and 5.79 in the positive. So that big swing we're seeing is the market's evaluation of our loan. In the second quarter, NYCERS purchased $12.5 million worth of loans to create a reserve 556 units of housing and made additional commitments for another 1,430 units of housing. If we go to, well, the next page is AFLO, CIO HIT, they're 10 and 11, and Access Capital Strategies on 12. You'll note that they didn't make a lot of new investments in the second quarter. In fact, they didn't make additional investments, so we don't have collateral benefits to report. But I will note AFLO CIO HIT is up 38 basis points over the, 50 basis points in the second quarter and 38 basis points over the last 12 months. Last time I came here, they were down 3 basis points, and I said they hold themselves to the benchmark, and we should expect them to see them up. That's precisely what they've done. And RBC Access, while it underperformed by 3 basis points in the second quarter, it outperformed by 118 basis points over the last 12 months. And I do want to make one staffing announcement now, because I know we're trying to go quickly. Kali Ndoy, who many of you may have known, was our investment officer running the PPAR program. She has left us to become a beneficiary, so she will be very concerned about what we're doing here today. But while she pursues some good works in Africa, she was able to train our new employee, Lauren Crowell, who comes to us from Domain Equities and primarily working with affordable housing, wage compliance, affordable housing, unit compliance, and a lot of the deal making. So it's bringing us a good expertise that we didn't have before. So with that, if there are no questions, I'll turn it over to private equity.
Brian. And we're going to start with that spiral bound total fund overview book on page 27. As a reminder, private equity reports on a lag, so we will be discussing performance for the quarter ended March 31st, 2015. And you'll recall Inash Kajela is on our private equity team, and I'll have him walk you through the results.
Good morning, everyone. So on page 27, we begin with the total portfolio overview and performance. And as of the first quarter, the total private equity portfolio had a market value of approximately $4.16 billion, which represented 7.7% of total NYCERS plan assets. In addition, the unfunded commitments were about $2 billion, which results in a total exposure of $6.1 billion to the asset class. As of the first quarter, the plan's since inception net IRR was 9.4%, and the investment multiple was 1.35 times. If I could, I'd like to turn your attention now to the big book, the agenda package, for a more detailed look at the quarterly results. And we will begin on page 26 with a snapshot of your portfolio and the quarterly performance. So here on page 26, if you look at the top of the performance summary table, you can see that as of March 31st, NYCERS had $7.2 billion in active commitments across 93 managers and 152 funds. And if you look at the bottom of the table, you'll see that the portfolio's since inception net IRR, which is the last line, increased 6 basis points quarter over quarter to 9.4%, while the net total value multiple increased slightly to 1.35 times over the quarter. Now let's take a quick look at the prior page, page 25, for some quarterly highlights. Within cash flow activity, the portfolio was cash flow positive by about $34 million, as distributions exceeded contributions. The private equity portfolio has now been cash flow positive in 8 of the last 9 quarters, which demonstrates its self-funding ability as it continues to mature. Under recent portfolio activity, you'll notice that both quarter over quarter and year over year, the portfolio value has increased net of cash flow activity. Over the prior quarter, the value of the portfolio increased by $111 million, or 3%, and over the prior year, the portfolio value increased $381 million, or 10%. Under new investment commitments, you'll see that NYCERS closed on 2 commitments during the quarter, $111 million in aggregate to 2 managers. And subsequent to quarter end through August 25th, NYCERS closed on an additional $331 million in commitments to 5 managers, which includes 2 emerging managers. Let's now turn to page 28 to review your portfolio returns over various time periods and against their relevant benchmarks. Since inception, the portfolio generated a 9.4% net IRR, which lags the program's benchmark by 400 basis points. As a reminder, the benchmark here is the Russell 3000 plus 300 basis points. And on a one-year basis, the portfolio generated a 9.8% net IRR, which does trail the program's benchmark by 560 basis points due to the continued outperformance of the public markets. However, given the long-dated nature of the asset class, we believe that these since inception figures are the most relevant. On the bottom of the page, you'll find your portfolio broken out, your portfolio performance broken out by strategy. And some of your best performing strategies are large buyout at a 17% net IRR, which includes names such as Apollo Global Management and Vista Equity. Special situations at a 17% net IRR, which includes Ares Management, and secondaries, which are at a 16% net IRR, and that includes Landmark and Ardent. And lastly, I'd like to turn your attention to page 35 to review your geographic diversification. Based on current market value at the bottom of the page, North America represents the largest exposure at 83%, Europe is at 13%, and the rest of the world is at 4%. We also break up New York State and New York City exposure here, and in terms of exposed market value, 8.4% of the portfolio is exposed to New York State-based companies, and of that, 7.1% is exposed to New York City-based companies. Are there any questions?
Thank you. And with that, we'll turn it to Yvonne Nelson in real estate.
Before we start, the highlights for the real estate performance for NYCERS for first quarter 2015, I'm really excited to introduce to you John Glusak, who joined the real estate team as a senior investment officer, and he's sitting right there with the white shirt. Maybe we can stand up a bit and just give a comment about everything.
Hi, my name is John Glusak. I have over 22 years of experience in commercial real estate. Credit trained in Merrill Lynch, where I spent 15 years. Ran a trading desk for commercial real estate at OBC Capital Markets for another 5, and I've been doing a lot of consulting work, setting up real estate accounting systems with GIC in Singapore and with Brookfield as well.
Thank you. Thank you. So I'm going to return back to the total fund overview, the spiral book. Real estate, there's an overview on page 32. I'm just going to give you the highlights because we actually have 2 items later on in the agenda, and we'll be speaking about the portfolio quite a bit. But as you can see at the top of page 32, you'll see the middle 2 lines address real estate. State Street kind of broke out the portfolio between the active portfolio and the totally liquidated portfolio. And as you can see, as you look across that total liquidation line, it represents 3 real estate funds that have fully liquidated and generated a 9.8% net IRR. And the line above it is our active portfolio, where we have 47 investments with about 33 managers. Together with that liquidated performance, the portfolio is yielding 6.8% on an after-fee basis of real estate. And with that, I'm going to go to the big board book on page 43 and continue with some other performance highlights for the NYCERS portfolio in real estate. You have that, Pat? This 143. So real assets, we have a 6% allocation to the asset class, plus or minus 2% for rebalancing. And I'm just speaking specifically about real estate. And as of the first quarter, the fair market value of what we have in the ground is $2.5 billion, or 4.6% of the portfolio. We have close to $700 million, about $688 million in commitments that we have yet to fund. So when we combine that together, we consider our total exposure to real estate at $1.8 billion, or 5.9% of the portfolio. Just talking a little bit about performance, this is a long-term asset class. Our performance for the quarter was under the benchmark. The benchmark is Odyssey plus 100 on an after-fee basis. And for the quarter, we were under that by 40 basis points. That was a combined performance between the non-core portfolio, which was a little under at 2.7%, and your core portfolio, which generated 3.3%. So on a blended basis for the quarter, it was 3%, slightly short. But if we look out for longer periods, on the right of the graph, and NYCERS is the dark bar. If you look out to the 1, 3, and 5 year, you see that the NYCERS portfolio is generating returns above its benchmark. These are time-weighted returns. Our benchmark is time-weighted. But if we just look to a dollar-weighted return, similar to the way that private equity regards theirs, again, the performance for the portfolio is 6.8% with a 1.3 times multiple. If we go on to the next page, page 2, it depicts the portfolio in a slightly different way based on strategy, and the portfolio is skewed toward non-core strategies at 58%, but we are still within our investment policy. And although the non-core managers underperformed for the quarter, if we look at the cash flow activity, $155 million was distributed to NYCERS for the quarter, and that exceeded the contributions that we sent out of $82 million. And these distributions were primarily from your non-core managers. Just skipping along to page 5 to show you the diversification of the portfolio by property type and by geography. The portfolio is well diversified. It's global in nature. Our exposure to ex-US markets at this particular time is about 12.5%, and coincidentally is also our exposure to New York City, specifically at 12.5%. So as I mentioned before, we have 2 items later on the agenda, so we will be talking about the real estate portfolio more extensively. But if you have any questions, I will take them. Now we have continued real assets.
Thanks, Yvonne.
Good morning. Before I go to the reporting for infrastructure, I would like to mention that we have a new addition to infrastructure that will be joining next week, starting on Monday. As some of you may know, Evan Nansen had left the city after 2 years of service and a great contribution to the infrastructure program, but he continued his career in an infrastructure fund. So we were lucky to quickly find, hopefully, as good of a replacement as Evan was. So I just wanted to mention that. Now, in terms of reporting, page 32 of the total overview, total fund overview book. It's the same page that Yvonne started her report from. Again, page 32. So if you look at the 4th line from the top, this shows infrastructure, and what you see is that the net IRR is 15%, market value is 36 million, and the original commitments are 195 million. So it's a very good result, but I would caution that it's very early in the program, so while it's good, it's not very meaningful at this point. With this, we could continue to the big book with all agenda items. And if you can please turn to page 56 and 57. On page 57, what you see is again a representation of the net IRR relative to the benchmark. The benchmark is CPI plus 4, And again, we have outperformance, but still very early stages in the program. I would also like to draw your attention to the geographic composition of the fund portfolio, and that's page 66. So currently, the majority of the investments are in North America, 62%, and followed by Europe, 38%. In terms of the sectors that the capital is deployed, these sectors are led by renewables, approximately 52%, followed by transportation with 17.5%, and energy 16%. Also on the next page, page 67, you could see the risk management matrix. The program is fully in compliance. And I would like to just draw your attention to the leverage, which is significantly lower than it is allowed by the program. And again, early stages, but so far the program is developing well. With that, I will conclude my remarks and see if there are any questions.
Thanks very much, Petra. We turn it to Callan now, and then Bud to take us through their performance observations.
Good morning. Our Callan performance summary begins on page 70 in the big book. And I'm not going to go through every page. A lot of it was covered by Scott and the asset class heads, but I would like to share with you some of the peer comparisons starting on page 77. On 77, we compare your total fund performance over time versus the very large public fund peer group, over $10 billion, similar to your fund. You see that the last couple of years has been slightly below median in the 61st and the 58th percentile, respectively. But since we changed the asset allocation back 3 3/4 years ago, performance is better, 40th percentile since then, and then the 5 and the 10-year number are also above median. Page 78 does a asset allocation adjusted ranking. So that says, well, what if everybody in the peer group had the same asset allocation as NYCERS? And you see that the numbers improve versus the peers. That represents that the implementation of the asset allocation is strong, and that the numbers since the new asset allocation is in the 21st percentile, and then going back 10 years in the 28th percentile. Page 79 compares the calendar year performance for the total fund versus peers and target. The performance is ahead of the benchmark in 7 of the last 9 years, and also above median in 7 of the last calendar years. And when you look at the risk statistics at the bottom of page 79, you see that the standard deviation and tracking error are below median, which means below peers. Flip ahead to page 80, and just looking at the domestic equity market in total, which includes the active and passive. And as you know, you have an overweight to passive management in domestic equity at 75% passive and approximately 25% active. The last year, 2 years, this is very endpoint sensitive, but the last 2 years, you see underperformance there as a result of some of the fundamental managers underperforming their benchmark. However, looking out longer periods of time, the portfolio is more in line with the benchmark and closer to median. Page 82 reflects just the active domestic equity performance, and as you can see, the 1-year number is behind the Russell 3000 index, and as was pointed out earlier, the performance was weak in the fundamental index managers as well as some of the fund-of-fund managers. However, you go back 3 years and that number does show improvement in the top 33rd percentile, and then since 10 years back, we're slightly ahead of the benchmark. 2014 on the calendar year basis there at the bottom of page 82 shows that 14 was a poor year. However, 13 and 12 were very good years. If you flip to 84, this is look at the total international equity portfolio. And this is almost a flip side of what we have in domestic, where only 20% is passive and 80% is active. And there's also a pretty significant overweight to emerging markets versus developed markets. And as you know, emerging markets haven't done as well as developed over the last 3 years or so. So the performance is below median, but typically at the total level is close to benchmark. Where you see the outperformance is in the active management, which is on page 86. So the total active international component of the international equity shows that over the last 1 year, 3 year, and 5 years, you're ahead of the benchmark, but still ranking below median versus peers. Page 88 has the fixed income allocation. Because we are still getting ramped up with opportunistic fixed income, we actually show against 2 different targets. The first on page 88 against the long-term target, and there's been some slight underperformance there over the last 2 years. However, there's outperformance going back to the 3rd year, 3-year number, and in the 22nd percentile. Certainly the allocation to the OFI has been very positive. And then when you look at the performance against the interim target, which is a more apples to apples for this time period, given that we're not fully invested in OFI, you see the performance numbers versus the interim target looking much better over the 2, 3, and 5 years. Sorry, that's on page 91. That concludes my comments. Be happy to answer questions or about specific managers and executive session.
Okay, thanks very much, Bud. The managers covered the personnel changes, and I can't let the public session end without commenting on the retirement of Martin Gantz. Martin, as you know, served NYCERS and the other 4 boards of New York City with distinction for 27 years. He ultimately decided to retire. We wish him well. We're thankful for his service. And one of the greatest gifts he gave to the city was some strong people to stand in for him. You met Robert Feng, who is the acting head of our active fixed income, or public fixed income, and Wesley Polisek, who's the head of our opportunistic fixed income. And there's a strong team behind that. So thank you for that, Martin. If you're watching this, turn your computer off and go to the beach. And thank you for your service. I'm going to comment on the ramifications of this from a personnel matter during the executive session, but because Martin has been watching these, I wanted to publicly for that. Okay. Let's go to the monthly returns. We have the July numbers for you. They're in the color flip book, which Mr. Dorsa would be happy to give you a fresh copy of.
Yes, sir.
Turn to page 39.
The Mets can use your pictures.
Yes.
We can see the results. I'm just going to do something to give you some orientation in terms of what you're looking at. If you look on page 39, on the 1, 2, 3, 4, 5, 6 column, 7 column over, FYE 630.15. These are the numbers we were just looking at. You look all the way down to the bottom, you can see that it's 3.4. So that's the gross figure. These have not been adjusted for the expenses. We're doing that with the quarterly report. So the number I'm going to give you for July is on a gross basis. If you look over to the 3rd column from the left, at the bottom there, NYCERS total employees up 32 basis points versus 65 for the benchmark, 33 basis points below. And you can see in red and green below where turn to page 32, we have a brief look at the asset allocation mix. We've been sticking to the same general strategy for much of the past year. We're essentially at policy weight for equity exposures on the left-hand side. They're plus and minus a little bit. You can see the emerging markets down at minus 0.6. Over time, we work to keep that number near zero, and you'll see it get closer to zero as the pressure numbers come in. On the fixed income side on the right, we've been consistently underweight long-term bonds in dark blue and TIPS in purple, and we've been offsetting that with some treasury securities, shorter-term treasury securities in gray. When you put them together, they give you a duration or interest rate sensitivity that's quite similar to the overall bond market as measured by the Barclays Aggregate Index. We have a long session, so I'm just going to give you a quick taste of market dynamics because there has been a lot of action. If you go to page 18, what we've done here, looking at S&P volatility, this is the uncertainty index. It's measuring implied volatility, and it essentially gives you a sense of the angst in the market over taking risk, what we all do for a living, taking financial risk. And you can see that things were very quiet for much of 2015, and then in August, we went off the charts again. This chart goes all the way up through September 8th. So it covers, you notice we've only been talking up through July. August was a dreadful month in the markets because of concern about China and macro movements and so forth. And you can see this in the uncertainty index, the volatility index. It settled down a little bit into the mid-20s, but it's still at fairly high levels. And you can see this in the paper. I mean, there was more uncertainty last night in overseas with the international markets down about 3% with concern. I mean, Volkswagen is now having some emissions troubles, and there's just all kinds of things to worry about. But over the course of commodity prices have been quite weak. Over the course of August, as you well know, the Chinese government, China being absolutely essential to incremental growth globally, the Chinese government was trying to use their macro policies to quell a run on the stock market. The Chinese stock market, as you know, very volatile, speculative market. They're trying to dampen speculation, then people get concerned, and they're trying to prop up the market with a flow of government funds. They didn't do such a good job of that, and then all of a sudden they devalued their currency in a way that surprised everyone. And it was the extremeness and unpredictability of the Chinese government that really threw everybody off. The numbers that come out of China are sketchy, and so we're dealing with a lot of uncertainty over the globe's most important incremental growth. And that uncertainty will continue, I believe, for coming months. And uncertainty is not necessarily bad if you're in the business of taking risk. Certainly you suffer, as people begin to price in uncertainty, you suffer a price shock, as we did in August. But what you do get is more reasonable prices, and you get paid for taking risk. And we can see that happening if we turn to pages 21 and 22. Because a lot of this portfolio is in fact securities where we're taking some risk, and we need to get paid for taking that risk over time if we're going to add extra return. You can see the bond markets up on the top panel on page 21. In red, we have the spread over treasuries for the high yield bonds. This is the incremental return that one gets for buying high yield bonds versus treasuries. And you can see that during the course of 2015, this has increased, and we're up to 544 basis points at the end of the period of this chart. On the other hand, down below, the price that we pay for earnings in the stock market is going down in the same way. So the price of risk is going up, the PE is going down. It's fallen in this chart from almost 20 times to 16, 17 times. Now that's still fulsome, but there's it's not at extremely high levels, and so you're beginning to get more reasonable prices for risk. If you turn to the pages behind it, and I won't go through them individually, you can see PE ratios for each of the markets, and just quickly look at page 25, where we can see juxtaposed against each other the movements in the markets in the U.S. in white, as measured by the Russell 3000 Index, in orange, the EFA or developed international markets, and then in yellow, the emerging markets. And as you can see, the emerging markets have been quite weak through the spring, through the summer, with them really deteriorating in August, and the spread, which was at the similar levels in September of 2014, is getting quite large. You can see that the developed and U.S. markets also had weak performance during August and have been chugging along at flatter rates so far in September. With that, I think I'm going to stop on the monthly report so that we can get to the other items. And the next item is the trustee education, but let me stop and see if there are any questions before we move on. Okay. We're going to turn now to Mike Garland, who heads our corporate governance and responsible investing area, to give you a little education about what we do there. We're very, very proud of this unit. They've done a magnificent job in bringing forth shareholder rights over the past many years. And Mike's here to use them.
Great, thank you, Scott, and good morning. I believe all of the trustees and people at the table have a copy of this presentation. There's an extra copy here if anybody needs. A couple, before I dive into the presentation, I just wanted to make a couple brief comments. I'm not here to report on specific initiatives. This is a basic overview of the program. Members of the proxy committee are probably quite familiar with this, and maybe some other long-serving trustees, but there has been some turnover on the board. We thought it would be helpful just to come and describe the program to the full board, what we do, why we do it. We will be meeting with the proxy committees. We have to schedule it, but I think in October, and reporting out on initiatives. I think we typically come at the December meeting, but to provide the proxy committee report. So I'm going to walk through this PowerPoint. I sometimes pick up a little steam as I go, so please interrupt and stop at any point if you have a question. So just starting on the first page, summary of what we do. First and foremost, we fulfill the board's fiduciary duty with respect to proxy voting. Roughly half of your portfolio is in public equity. 2/3 of that is in domestic public equity. You hold roughly 3,500 U.S. public companies and nearly as many outside the U.S. Each of those companies has an annual meeting every year where shareholders elect directors, vote on executive pay and other matters. The proxy vote attached to those shares are considered plan assets and must be exercised in the best interest of your participants and beneficiaries. And so we in the Controller's Office, with respect to domestic and regarding internationally, or investment managers, vote those proxies consistent with policies put in place by the proxy committees. In addition to proxy voting, we also actively engage portfolio companies through active ownership. I'll talk about that a little bit more, but it's really to strengthen corporate governance and promote sustainable business practices, ultimately seeking to protect and create long-term value. Additional responsibilities among these, beyond proxy voting and company engagement, we collaborate particularly around company engagement, regulatory engagement with other institutional investors, and there's a long history of collaboration, both formal and informal. We engage regulatory bodies, the Securities and Exchange Commission, for example, stock exchanges, but potentially also other regulators like the Environmental Protection Agency, where we think an investor voice in a particular reform may be important. And then generally we serve as a resource within BAM and to the boards on a variety of responsible investment areas that go beyond our core set of responsibilities. We have an 8-member team. We recently added a senior staff person who's here, Scott Drazel, who many of you may know. Scott previously oversaw the corporate governance program with the Amalgamated Bank, one of your investment managers, and he adds really important capacity to our program, will allow us to broaden and deepen our work. So we're happy to have him. Turning to the next slide, why, beyond just the fiduciary obligation with respect to proxy voting, why what we do is important really speaks to the structure of your portfolio and your time horizon. As you know, you're a long-term investor, but also the fact that certainly domestically, I think 80% of your equities are in index funds, so you're essentially a permanent owner of these companies. You can't sell just because you have concerns about the accounting practices, the business strategy, the transparency, you name it. If you have concerns or your manager has a concern about a company, you can't do what some people call the Wall Street walk and just sell. You vote with your feet and walk away. So the only way to protect and create value is to actively engage these companies, make sure we have a strong, independent, qualified board, push companies to be more transparent, have policies that address a broad range of financial and non-financial risks. And there are a broad set of tools we have to do that. And I'll talk about that in a minute. Let me just, turning the slide, some of the issues that we typically engage companies on. First and foremost, the board. We want boards that are independent, accountable. I think that's been the efforts over the past decade or more more thinking about really board quality. We want not only truly independent directors, but we want the right mix of directors in the boardroom, diverse perspectives, diverse skills and experience. We engage on executive pay. We want it aligned with performance. Workforce diversity, worker and human rights issues, a very long history with this board and with the other boards engaging portfolio companies on worker and human rights risk. Climate change, environmental risk, corporate political spending disclosure. And there is a long history here of engaging portfolio companies on a broad set of issues. I think in recent years, particularly coming out of Harvard, there's more and more empirical research that shows that sustainable business practices are correlated with better performance and better long-term performance. People can also always point to research that the research is not always consistent, but it's easy to point to the counterfactuals. Whether it's Enron, where a weak board and bad accounting practices destroy value and undermine the markets, the global financial crisis, where excessive risk-taking in the boardroom and corporate governance breakdowns were a contributing cause. Companies like Massey Energy, where poor worker safety practices ended up killing 29 lives and destroying 40% of the value of that company. Or the BP spill, where weak environmental compliance and practices ended up a costly environmental spill that also harmed shareholders. Turning to slide 4, I talked about the various tools we have. This is what we call the continuum of active ownership. And distinguishing active ownership from active management. As you know, active management is those managers who buy and sell stock. Active ownership is where you are a long-term owner exercising your rights as an owner. And we are, and you are, to the far end of this spectrum. NYCERS and the other New York City funds are among the most, probably the most active institutional investor in the world when it comes to submitting shareholder proposals. Has long submitted a lot of shareholder proposals that
get voted on every year at portfolio companies. You occasionally serve as lead plaintiff in litigation, have publicly opposed directors in elections, vote no campaigns. This last box, running director candidates, is something I don't believe New York City has ever done, nor maybe there may be an exception, but generally it's not a place where public pension funds have had the capacity to do because of the costs of running your own slate. I'll reference it in a minute, but the Boardroom Accountability Project we launched last year is seeking to give us a right, which we're well on our way to getting, that will make it more feasible for New York City in collaboration with other investors on very, I think, rarely, but where there was really a compelling case, it creates the possibility of nominating directors. Slide 5, I referenced before, and I think we're aware of, there's a very long history of both leadership here in collaboration with other institutional investors. Was Controller Paris Rowland, I believe, who was a founding co-chair of the Council of Institutional Investors. NYCERS has a direct membership to the council. I co-chair the activism committee there. Series, and as part of that, the Investor Network on Climate Risk that was established in 1989. I think Controller Holtzman was a leader, and Controller Stringer actually serves on the board of Series, and NYCERS has a direct membership to the Investor Network on Climate Risk, which is part of Series. There's at least a 25-year history of spearheading individual reforms in portfolio companies. For example, the McBride principles, where New York City was a pioneer to prohibit workplace discrimination in Northern Ireland. New York City's been a leader on advancing sexual non-discrimination policies at portfolio companies. And just to give you a flavor of some of our current collaborative work, we are a participant in something called the Human Capital Working Group, which is led by the UAW Retirees Medical Benefits Trust, and it's a large group of institutional investors. And I would call this a soft engagement. We're not promoting a specific reform, but we're moving beyond thinking about worker rights and human rights to think about human capital and workers as an asset to be maximized, not just a cost to be minimized. And what are best practices in the marketplace about companies who have developed a philosophy around human capital, but also, what are the metrics their boards to use to monitor, whether it's turnover ratios, training, and what is it that we as shareholders should be asking for disclosure so we can monitor and evaluate those programs. We're also part of a very large group of global investors engaged in something like 55 of the largest fossil fuel companies in the world, U.S. and non-U.S., asking them to provide risk scenario analyses under 2 scenarios. Business as usual, where they continue to use as much carbon as the market would bear, and then under a scenario where there's a political will globally to limit global warming to 2 degrees centigrade, and what that might mean for their long-term business plan in a, if there's a cost on carbon or in a carbon-constrained world. And then finally, the Boardroom Accountability Project, which is really where New York City has been in the lead, but we are really collaborating with some large investors. CalPERS in particular has been tremendously supportive, but loosely collaborating with TIAA-CREF and Norges. And this is the effort I mentioned where we're seeking a reform called proxy access. And what proxy access is a right for substantial long-term holders to include a limited number of our director nominees on the company's ballot. So today, if Carl Icahn wants to run directors for a board, he can spend millions of dollars to print his own ballot, distribute it to shareholders, and that's what people consider a proxy fight. The company's ballot, and that happens very rarely, by the way, 99% of the time we get a ballot in the mail. It's a 10-member board. There are 10 nominees listed. So we only have the opportunity to vote on 10 nominees, and it's the nominees put forward by the board itself. So what we want is the right for a group of, if you've held 3%, either individually or collectively, for 3 years, the right to include nominees constituting up to a quarter of the board in the proxy statement. It's not to take control of a company or influence control, it's to put some genuinely independent directors on a board. This is something that investors have, including New York City in particular, fought for since the collapse of Enron. The SEC proposed a rule in 2003 that would have put this in place at all companies. It never moved forward. They proposed it again in 2010. In Dodd-Frank, there was a provision authorizing the SEC to enact the rule because there was concern that the Chamber of Commerce was going to sue. The SEC approved the rule. The Chamber of Commerce sued anyway and won on procedural grounds. So we had this right at all of our portfolio companies for all of a month, and it was taken away. We now have the right to go company by company to ask and to push for this right. So we went at 75 companies last fall, in total with other investors over 100 this year, and the landscape has shifted dramatically. So if you just turn the page on slide 6, just to give you, and I'll be giving a full report to the proxy committee, and I can come back to the full boards. But I can tell you a quick talking point. Last year at this time, there were 6 companies in the United States that had proxy access that one might consider on workable terms. Today, there are 40, heading toward 100 by the end of the year. I can also tell you that because the city publicly announced all 75 on one day, last November 6th, that permitted the Securities and Exchange Commission economic staff to conduct an event study about what impact that had on the market. So the SEC's economists analyzed the release of New York City's project and concluded that it caused a 50 basis point abnormal positive return of our portfolio companies. That was merely our asking for the right. We haven't necessarily achieved it at those companies, but that was an econometric analysis that demonstrated that even the specter of the right had a positive impact on the market.
And there's a prospect on the board.
The
prospect.
The prospect.
The specter.
Right. The prospect, yes. The value of proxy access is once it's in place, it's the specter of a nominee, I think, where the value is.
He's getting specter in there.
Finally, on slide 7, I referenced earlier some of the other responsible investment activities that go beyond the core proxy voting and company engagement. We assist with responding to various surveys. The Asset Owner Disclosure Project is a group that rates the 200 largest pension funds on how they are addressing climate change. They rate you whether you respond to their survey or not, based on what they can find publicly. In 2013, NYCERS got a D rating and was ranked 55th. I saw that, I argued with them, it didn't matter. The next year we completed the survey, and in 2014 we got an A rating, AAA being the highest. Your rating went up to 20th in the world and 5th in the US. We also work closely with Santander to complete the PRI disclosure survey. Both of these, and the PRI in particular, are pretty onerous in terms of reporting requirements. We are working with our BAM colleagues, particularly in real estate and infrastructure, with Petya and Yvonne and others in BAM, and with the legal team to review the responsible contractor policy, benchmark it to peers, and are looking to strengthen that policy so we have a tool that will both help manage risk and provide a roadmap for the responsibilities of the various people under the policy. And finally, we help evaluate the responses when there's an ESG questionnaire that goes out to managers as part of the search process, and our team helps to evaluate those responses for BAM. With that, any questions?
Questions
Oh,
for Mike?
right. Since
What else? Okay.
Yeah.
So, you know, what guidance would you, or recommendations would you give in terms of applying ESG principles in the private equity and hedge fund spaces?
I would want to work with my private equity colleagues. I mean, some of the principles I think would be similar, and I believe that the private equity folks are either working on a set of questions or looking at some, adopting some that are developed by ILTA.
Yeah, that would be for their fee transparency.
Okay. I'm not sure directly how to respond to the question. I mean, I'm happy to work with the board and the private equity people. Certainly, the principles that inform our view about financial and non-financial risks are relevant across asset classes. Some of the specifics around public equity, you know, corporate governance in the public equity space is about solving a control problem. You have a very diffuse investor base where owner, you know, I mentioned the proxy access, 3% would give you the right. The 5 funds collectively rarely hold even 0.5%. So you have a real problem there that doesn't exist in private equity. The owners really are in a position between the GP and the LP to exercise control. And some of the other factors and their link to value and risk, I think are relevant.
So in terms of, right, because often in the alternative space, right, you have lockup provisions, longer holding, you know, the inherently liquid assets, liquid positions, but at the same time, we are aware, just like we do in every other asset class, and consider the implications of our investments and the implications of of how our managers behave. So that responsibility doesn't fall short just because we're talking the alternative space.
I agree.
Thank you.
I just want to do a follow-up. The ESG questionnaire that Pam asks prospective investment managers to fill out, that's for alternatives managers as well, right? Private equity, hedge funds.
Yeah, in the procurement, it's a formal question, and I believe I was just thinking actually as Mike was talking, Alex, it's in the DDQ, we ask ESG questions. So
Yes, if you guys risk compliance and ESG related questions in our due diligence questionnaires for private equity.
So they would be the same that ask them to talk about their, you know, how they use the ESG lens and so forth.
And are those questionnaires used to score the responses for procurement?
For the public asset classes, I believe it is used qualitatively when we're scoring, like many of the factors. It's one of the things we take into consideration. It's not, you know, there's not a specific factor placed on ESG. Where's Jennifer?
Yeah, it's not weighted. There's no weight attached to it, but and I'm trying to remember when we did the EQUA review. It's been a few years, but we certainly rendered a judgment which appeared stronger. So it was qualitative. I don't know that we distilled it down to a quantitative number. We may have distilled it down to a quantitative number for evaluation purposes, but it had no weight associated with it.
So it would be similar. I was in front of this board several months ago talking about our diversity policy, our diversity questions, and we asked about the diversity of the decision-making team. We look at track record. We look at succession plan. We look at ESG policy. We look at a variety of factors, and they're looked at qualitatively, coming up with a score for the.
Okay, I'm not sure I totally understand that, but we don't need to take up a lot of time for that.
The various people that sit on the panel that are scoring the manager consider the answers to the ESG questions as they consider the answers to the other questions, but there's not a mathematical score applied to the ESG questions.
But there is a mathematical score applied to other considerations in the hiring?
Correct. Jen, what do we
sometimes on cost, if that has a score. But in general, we look at the organization and that the ESG would be part of the organization. It's really part of the mosaic when evaluating the firm and the strategy.
Okay. Elisa, let me, can we know for the record that the Queensboro president, representative is present, as is the Manhattan Borough president.
Thank you. Just to follow up on the question, so when BAM does a solicitation and puts out an RFP, do you ask for this statement?
Yeah.
Okay, so then you're getting it back.
Yeah, so we have a series of questions related to issues we do for all these other things. And they give us back a response. That response is evaluated along with these other factors in a qualitative way and ends up in the overall score that Scott said is part of the mosaic.
Okay, so it's asked and it's assumed that when you do a solicitation, the proposer has an idea of what the categories are that they're going to be scored on, obviously, because you're asking them for certain information.
Right, they will be evaluated based on their response to this and the other questions. What I was talking with is, mathematically, is there a specific score placed on ESG? No, it's part of a broader evaluation.
And what would
They
we-
respond to the ESG questions, and we consider their response as we evaluate the strength of the manager.
No, so what would be a downside to putting a numerical value on that, like you would do cost and other things?
We can certainly consider it. It would be a longer discussion. There are things that we cannot, as a matter of law, put specific weightings on, like diversity. That would be illegal for us to do it. But things like ESG, I think, are part of a broader discussion. But we, generally speaking, try not to be overly prescriptive in how we structure this so that you can weigh various factors.
No, and that's part of a robust, I think, evaluation process to have factors, a lot of factors, and obviously these are very complex proposals I'm sure you're getting back. But I think if it helps the messaging in a way, I think, to know that there will be some points given, and unless there's, and it almost sounds like from, and I caught the tail end of your presentation, so I apologize, but even raising not the specter, I forgot, of, some of the stuff actually has some sort of positive impact, and I just, I wouldn't want us to be kind of, shy about that.
I think there's no question about the fact that, and John can amplify this, we ask the ESG questions. We look carefully at the response. If you have a manager that's non-responsive to our ESG questions, does not seem to have a well thought out ESG policy, that'll count against them, and that'll stand out. On the other hand, if you have a manager that has a distinctive policy that goes beyond the depth of other competing managers, that's going to count in their favor. And on factors like this, I think you don't necessarily gain a lot from putting specific mathematical weights on it. What happens is when you have an outlier, it really impacts the evaluation.
Would it be helpful if I just spent maybe a minute and sort of described the kind of information you talk about? It's not about having specific to the head of policy. It's a pretty in-depth. I think there's close to 30 questions. It's very benign. Are they a signatory to the PRI? And then you get into how, even though our managers don't vote our proxies, the board has retains that right, and we exercise that responsibility. We care how they vote other people's money because it's a window into how they think about these issues.
Right.
What kind of capacity do they have? Is it bifurcated from the people making investment decisions, or is it integrated? What kind of external resources do they get? Because we're aware of the research providers out there, and you can get a sense of how seriously they take it by what kind of resources they dedicate to actually informing that analysis. So, the questions do elicit a pretty good view. Now, you get some pretty honest responses. You may get a quantitative manager saying, we don't think this is not in our model, so we don't take it into consideration. So, there is a subjective quality to it, but it does allow one to make judgments.
Larry?
Yeah, so I remember when this was first integrated into the RFP process, it was actually Jimmy Yan, who's now works with the Controller's Office, and a few of us who talked about this. And at the time, ESG was a novel concept for a lot of firms who had not considered it at all. The RFP responses were, we don't consider it. And certainly if we're looking at passive investors, it's a lot less of a numerical issue, as we want to know that you're actually thinking about these things. And I think the Controller's Office has done a fairly good job at being able to review this, especially integrating Mike's group, which didn't always occur, into reviewing these processes, and really kind of push the industry towards looking towards this. A hard score might be easier to do, but it may not yield the best managers. So I think it's just important that the Controller's Office, expertise in this and the way in which they've been responding to it, and the procurement team, be considered before a decision like that.
And you're quite right in calling out Jimmy Yan, who now works for me, is integrally involved in these matters. So you can rest assured we're attending to them. And Jimmy was, of course, also behind a lot of the work that led to our diversity policy.
And the other point I wanted to make was to Ray's point, which the proxy committee, we have spoken in the past. I have raised some of the issues around private equity and engagement. And the Controller's Office via the proxy committee has always looked at it as their role on public securities. But Ray is absolutely right that a lot of these issues could be looked at in a more dedicated way, integrating a little bit of what private equity does with our engagement, maybe as a separate component or focused group on some common principles and ideas that we espouse for private equity and other alternatives that could be explored as a potential idea for more active LP engagement on voting on boards and as we especially get LP positions, which is one of the things we fight for when we hire. So it would be good to at least think about whether there could be a more dedicated unit towards private equity and other alternative engagement to push for better practices.
I'd like to just throw out a suggestion, which is that we sort of talk around the edges of how BAM does procurement, but it might be useful to have one of these trustee education sessions about this sort of whole procurement process, soup to nuts, so that we have a more thorough understanding. Maybe it's just for newer trustees like me. Maybe it doesn't need to take place at a board meeting. It could be an offline session, but I think that would be useful. I don't know if anybody else thinks so.
I mean, I think it's a good idea. It would serve two purposes. One, refresh the board about it, and two, since these are held in public session, it would inform the public about how we procure these managers, and we'd be happy to do that.
Thanks.
Okay. Is that concludes
Thank
Mike's
you.
presentation. Thank you very much for that. I just wanted to briefly give an update on our asset allocation study that we're conducting with Callan and the four other general consultants that work with New York City's systems. We're doing this simultaneously with all of the other systems. We have met, Bud and team have met with Sherry, Actuary's office, and my team, and the other general consultants to make sure that we have a common approach to evaluating this, a common approach to developing expectations, a common approach to analyzing the efficacy of changing our asset allocation, both from the perspective of our current asset allocation and from the perspective of a blank sheet of paper, starting with two assets, indexed equity and indexed fixed income, and looking at what asset classes could you add to that mix to improve the efficiency of the portfolio. And then looking at the risk of the portfolio, we want to go beyond just reporting to me about standard deviation, and we want to talk to you about what does standard deviation mean. And with that, we're working closely with the actuary's office to be able to develop a definition of risk that sort of is more useful for the boards to consider, and we'll be back to you on that. I've met with Callan at least one other time. I met three total. So 2 other times after the group meeting. We may have one more individual meeting, and then meet sometime in October with all the consultants again, before coming back to you with some initial thoughts and recommendations for you to begin what is perhaps the most important exercise that this board does, which is to consider asset allocation. And we'll iterate as long as it takes to get you to a place where you're comfortable with the asset allocation for this system. I'm encouraged by the dialogue with Sherry and the consultants. I think we're going to have some interesting things for you. I don't know if Bud, you or Sherry wanted to add anything to it.
Nothing really that you haven't already covered. It's an iterative process, and we're working to get on the same page as the other consultants that have one process, but taking into our consideration our specific capital market expectations.
So, when would you expect to engage the board in a substantive conversation about asset allocation?
I'm hoping to do it in the fourth quarter. At some point in time, November, for argument's sake, right now. But I want to make sure that we've distilled things to the point where we can set up a useful conversation before we do it. I think it'll be a higher quality conversation if we can do that. We're going. The last meeting was with the asset allocation expert at Callan, and Miles Draycott, our risk manager at BAM, and myself, and we were, way in the weeds on how they construct their model and how they use the model. It's very, very helpful, but it's, highly technical discussion, and we hope to come up with something that's in pieces that are more approachable. Okay.
Questions?
And we'll continue to report periodically on it until we're actually in front of you for the full discussion. Our last item for public agenda, Mr. Chairman, is the gun resolution update, and I'll turn it to Callan to take you through.
So hopefully you've all received the copy of the memo with regard to the gun resolution. And basically in the memo, what we tried to do is to outline what your total exposure is to the 5 companies that we identified as having significant revenues derived from selling guns and ammunition. And I'll just walk you through what that exposure is and what who the 5 companies are. It is Walmart, Kroger, Cabela's, Dick's Sporting Goods, and Big 5 Sporting Goods. And the majority of the ownership, as you might expect from a market capitalization, is the exposure to Walmart and then to a lesser extent Kroger. So on the equity side of the ledger, there is $137.7 million of exposure to those 5 securities. It's broken down in the passive portfolio of about 87.6 and in the active portfolio of 50 million. Within the active managers, there are a number of managers that have a significant exposure from a percent of who the top holdings. And for instance, VTL, Walmart is the #1 holding in that portfolio. And that's what the numbers in the parentheses mean next to the market value number. There also is a smaller exposure to fixed income among these 5 securities, and that that is on page 2 with total exposure of $21.8 million between the two securities of Walmart and Kroger. So in total, at the portfolio level, there is $159.4 million. And that is a significant amount when you consider not really as a percentage of your total assets, which are in the neighborhood of $54 billion. It's a relatively small exposure, but when you break it down as a percentage of each account that is exposed to, it does have a range of up to 5% in the BTL case. And just from an index exposure, Walmart and Kroger make up 82 basis points of the S&P 500, which is a relatively significant amount. And then the other 5 together in the Russell 3, which includes the small cap stocks, have a total exposure of 69 basis points. And so the two main things we focused on was what's the exposure, what would it cost to divest from these 5 securities, and because we are not a broker-dealer or an expert in transition management, we did ask the services of Russell Investment Transition Services to take a look at these securities in the amounts. They provided a estimate that for the equity portion, it would cost approximately $561,000 to divest from these securities. And for the fixed income portion, it would cost approximately $76.8 million. And those are not $1,000, and those are estimates. However, there are some investment implications that go beyond what the cost is to divest from these securities. And again, it's a function of the fact that it is a relatively large portion of the index funds and of the active management in turn. And so one of the big issues is that when you hire a passive manager, you're asking them to have a very tight tracking error to the index they're trying to replicate. And one of the things we looked at was what if we had divestment of these securities, and what would that tracking error look like compared to the typical tracking error you see from the average index manager in the S&P 500 index space as well as the Russell 3000 index space. And on page 6 of the memo, you see that the tracking error can be higher in the amount of about 5 times versus what it would be when those securities are contained in the index fund. And so that is one concern for us. And then a number of things that we considered that were not part of the mandate when we were asked to take a look at that is what implications this might have on just, managing the portfolio going forward in light of trying to benchmark these managers, passive and active, going forward. And some of those issues are outlined on page 7, suggesting that, will active managers be willing to manage a portfolio against a benchmark index that includes securities they are no longer allowed to invest in? That could be a tough position to be in when index has securities and the active management is not allowed to buy them. So one of the suggested remedies for that is to create a custom index that excludes those securities. And that is possible to do, but we need to look at what would be the cost implications of having a customized index. Who would be doing that for us? Would we get Russell or S&P to create that customized index, and what would it cost? Also, with the passive managers, we are paying a very small fee to manage these assets. And if we had asked them to manage a new portfolio against a customized index, it's possible that those fees could go up. And then just as far as renegotiating contracts maybe in order to solve all this. So in summary, we're not making any judgment on the social benefits of divestment here. And we recognize that a similar discussion took place in 2013 when we decided to divest from the manufacturers of guns and ammo. But at that point, it was a very small number that we were talking about and a very small exposure to the index. And that was in the amount of 14 million of total exposure at that time. Really a de minimis amount and insignificant impact on both the active and the index managers. So really from our perspective, what we want you to consider is, number one, what the cost implications are, which is probably the least of your worries, but that's $500,000 or so to divest. And then going forward, it would be benchmarking and monitoring portfolios that could cost more to implement.
Okay, thank you, Bud. Larry?
Yeah, on behalf of the public advocate who made the initial resolution to have the study done, we wanted to thank you for doing it as quick as you have. You know, the public advocate still believes that there's risk associated with divestment and risk associated with ownership of gun retailers. However, we just received this late last week, so while we believe that this is something that we can address a lot of the questions and concerns that you have, at this time that wouldn't be prudent to really do this the justice. You mentioned the 2013 divestment of retailers, which was not changed at customary benchmarking. Excuse me, manufacturers, thank you. It was a year-long process, and there was a lot of discussion and evaluation of some of the issues you talked about, customary benchmarks and others. And therefore, we would like to have that additional time to have that conversation with consultants and them in a prudent and reasonable way, while we can still maintain the belief that this is a risk to the portfolio. We would like to have that opportunity, so we are not moving on any matter at this moment, but we will take this up at the appropriate time in consultation with BAM and consultant.
Please see if there's any other questions or comments from board members, either for Bud or for anybody else here. Okay, so we'll table the question of the resolution issue for now, and I think when the public advocate is ready, can inform Dan to put it back in the chamber.
Mr. Chairman, that concludes our public session.
So before we leave public session, I just want to ask Ray Sanchez if he wants to say anything about the memo or the questions that he sent to Callan regarding our investments in Puerto Rico, for which we all received an email yesterday, I think, with answers.
Yeah, just thank you, Callan, for the follow-up, and BAM for that collaboration. I'm not sure if other trustees have since everyone received that, if anybody else has additional questions as of right now, I think my follow-ups will be more appropriate for executive session, but at the same time, if individuals want to have that session and share my curiosity or have other additional follow-up questions, I'd welcome that discussion in executive session.
Okay. Anybody have anything to say here in public session? Okay. So in that case, I think a motion is in order to exit public session and enter into executive session.
So moved.
Second.
Moved and seconded. Okay, all in favor, please say aye.
Aye.
Opposed?